This is shocking. I'm your host, Steve Van Metre, and thanks for joining me today. Our lead story today, BlackRock's CEO signals imminent economic disaster, and you're not going to believe what he says is going to trigger it. Plus, we have new evidence that now says the U.S. economy may be within weeks of a recession. And if you're wondering what we're doing in China today, well, we're looking for evidence of the mythical soft landing. Let's over to Bloomberg, where we picked today's story up with a headline: China manufacturing activity in first expansion since March. And now all of a sudden we see hope coming out of China that maybe the manufacturing sector is starting to turn around, because everyone said that the services sector will lead manufacturing up. What did we actually see? A pullback in services, and now we're getting some indication that maybe there's stabilization in China's manufacturing sector. This causing policymakers and other experts around the world to breathe a sigh of relief, because we need to see the Chinese economy turn around. The problem is it really just a big turnaround, or are we about to make another big leg lower? The official manufacturing purchasers manager index rose to 50.2 this month from 49.7 in August, beating expectations since climbing above a 50 level that separates expansion from contraction. Now, mind you, this is the excitement. We went from 49.7, so a very slight contraction, just an edge of a little contraction, to a very slight expansion, 50.2. That 0.2 is almost meaningless. All it tells us is the manufacturing sector went nowhere last month. It spun its wheels, and yet all of a sudden you hear this hope that, hey, perhaps the bottom is in. And that's what every policymaker needs right now, is a bit of hope, because they know if the global economy doesn't turn around and soon, we have a major problem on our hands. A gauge of non-manufacturing activity, which captures the services and construction sectors, rose to 51.7 from 51 in August, above forecast. So that's a positive direction there, again suggesting that maybe services leads the manufacturing sector. Well, historically, it's the other way around. The PMI reading reinforces our view that the economy starts to stabilize, which is a big stretch here. We have 1 month of data. A bright spot is a strong reading of input prices, suggesting the deflationary pressure is at least relieved a bit. And that's simply because economic data doesn't go in a straight line. There's going to be bumps and undulations. The question is, are we really at a bottom here, and this is the beginning of a turnaround? Or is this just a pause in another leg lower? Weigh in the comments, what do you think? Is this China's turnaround, or is it just more down? Recent indicators have been suggesting a bottoming out of the worst of the slowdown. Industrial profits did rise in August for the first time in more than a year, while a drop in exports has eased and credit has grown more than expected. Of course, we know a drop in exports is bad news when you're the world's largest exporter. Of course, that's China. That is just not good news. It tells us demand from the rest of the economy is slowing here. And the issue we see is that hope. It's just hope springs eternal in China, because they can't generate enough internal demand from their consumers to spur their economic growth. So they have to look outside to the rest of the world. They're saying, hey, there's a bottom here. We're looking at the other data saying, look, if you're looking outside of China, there's no bottom in sight. This is just a mere pause as we hit that holiday data and we hit the back to school data, which just put some bump in the manufacturing data, and watch, it's about to turn lower. Even so, the economy's outlook remains uncertain, that to say the least. Economists cut their forecast for GDP expansion in the latest survey, now seeing the country just above meeting its target of around 5% of the year. And of course, now if you don't know, for China, that's really low, because the problem with China isn't its manufacturing sector. We know where the real problem is. It's its property sector. As China's stock investors say, worst yet to come in the property crisis. No surprise, we've been making the case. Well, there's no way they can get out of this situation. The property sector takes down the banking sector, and there goes the Chinese economy with it. We're in the worst of the cycle, and we're not out of the woods yet. It's going to take a long time for current property crisis to be over. Before the property crisis is properly handled, it's unlikely for the stock market sentiment to recover meaningfully. Why? because you start to understand that China's internal economy is their property market, and that is their banking system, and it's the stock market. Everything hinges on the property market, and if consumers do not come out and spend, that's what we're looking for. If it doesn't happen, China's economy takes another big leg lower. The property developers start to fail, takes down the banking system and the stock market with it. It is just a domino effect to the downside. Meanwhile, the onshore yuan earlier this month slumped to the weakest since December 2007 against the dollar because nobody wants it. And that's an issue. Not even people in China want it. There's no trade going on it. We see all of the issues here that their currency is weakening. That means global trade is not as strong as everyone's hoping it is. The continued selling by foreign funds has driven bets that the worst of the outflows may be over. Less than a third of those surveyed expected fund flows via the so-called Stock Connect program to turn negative on a net basis for the year. The other problem you have here is when people don't want your currency, this becomes an issue in terms of getting currency to keep the economic system afloat. You need money to pay on debts. Without it, what happens? We start to see these delinquencies. We see these property developers miss their payments on their bonds. And what dollar denomination they're missing? Mainly dollar denominated bonds. Can't get enough dollars because not enough dollars are flowing into the country through global trade. But one thing you could have a lot of dollars in, and that's your trading account. If you had the double combination of our CTA-Timer Pro and Momentum Timer Pro reports, it will change how you trade. Let's take a look at this. Here's the dollar, 5.6% gain while on this trade. Meanwhile, what's going on with the rest of the market? It's going down. People are looking for answers. Our reports told you you could have bought here or here. You'd be up around 5.6% on one of the simplest trades we've ever shown you here from our CTA report. This looks at machine positioning, runs a historical overlay. We told our subscribers, we've been warning them. We're going back to July 25th. You see UUP was max short. We told them when this turns, that's where you got your signal. There was the first one. The very next day, our Momentum Timer Pro report. This one looks at momentum signals. It smooths them out for you. All those technical indicators, you don't have to worry about it. Look here, UUP, one buy signal. We've got a subscriber. He said he's been trading for 40 years. He says, I got both reports. When they confirm, I buy. Steve, it's so easy. It can be that easy for you too. Links for both in the description below. And right now, for a limited time, Momentum Timer Pro, your first month, it's on me. Because the shutdown poses political risk and risk to the U.S. economy across the Washington spectrum, this is a bigger issue than most people understand. And yes, there's a lot of politicking going on here, and for good reason. Both sides are looking at the White House. Obviously, Democrats looking to keep it, Republicans looking to take it over, and they're hoping, at least one side's hoping, that voters forget about what's about to happen, while the other side is saying, look, we're going to remind you what the other party did here, because the issue is if we see a government shutdown that lasts a couple weeks, potentially even a month, as we've seen in the past, we are risking the U.S. economy heading into recession. It is a dangerous game that's being played right now, but the outcome for both sides is huge. The fall is likely to spread across the political spectrum as it poses risk for President Joe Biden, as I've been saying, who must sell voters on his economic leadership. So you think about that, what he's got to do is convince people that he is driving the bus of the economy, and it's a good thing. And if they want it to continue, they vote for him. The problem is if we go into a recession, voters vote with their wallet. They have a big change in their mind on what's going on here. And if you don't think the Republicans know it, they do. And for his likely opponent in 2024, Donald Trump has cheered on holdout Republicans blocking a budget pact. A poll from Monmouth University released this week showed 3% of Americans would blame Republicans in Congress for a shutdown, while 27% would blame Biden and 21% would hold congressional Democrats responsible. Of course, this gives, what you see is congressional Democrats, a lot of ammo to say, hey, look, you guys got to get this thing done because it's not popular move. The real issue will voters actually remember come time the election? Because you think about the economy. We had the inverted yield curve. 6 months later, which was the average when everyone thought we'd be in a recession, didn't happen. And so what eventually happens? Everyone says it doesn't matter. They forget about it and they move on. There's a ploy here. Think about what the move is. It makes sense. Will voters remember this, or will they be dealing with the fact the economy's in a recession and people losing their jobs? I think the latter is going to be the one with more impact. As Biden faces risk of a shutdown further imperils the U.S. economy already being tested by an auto worker strike. And this will have an impact, higher interest rates and rising oil prices. And we know we go back to the global financial crisis, and you can see what broke the economy was rising oil prices at a time when wages, total compensation were slowing down. Consumers couldn't afford to continue spending against higher energy prices, and it was the last straw that broke the economy's back. We're seeing that again. And recent polls show the Democratic president dead heat with Trump in a potential 2024 rematch. But funding the government is one of the most basic fundamental responsibilities of Congress, Biden says, and sure enough it is. And if Republicans in the House don't start doing their job, well, we should stop electing them. Of course, again, the question is, do we even get far enough along before we're into a recession? And BlackRock's Fink says looming U.S. shutdown. This is irrational and scary, and we're not even getting to the point. We're almost to the point where we hear what, of course, Larry Fink says is going to send the U.S. economy into an economic crisis. But hang tight, because he weighs in on what's going on with the shutdown. Let's see what he has to say. Can you imagine going to your bank and saying, well, I'm not paying my mortgage? I mean, that's what they're doing. But again, it's the government. Everyone knows they're going to pay, just not today. It's irrational from my vantage point. It's wrong from my vantage point. The U.S. government is fast approaching another shutdown unless Congress enacts a temporary spending bill before the new fiscal year starts October 1st. And as of the time of recording, it does not appear this is going to happen tonight, and the government will shut down on Sunday and going into next week unless something is done. And we'll see. Doesn't look like it, but anything can happen at the last minute. It's political, and as we know, politics today that creates the fear, and it's scary, he said. Politicians should provide more hope to voters to help bolster confidence. And you can see it makes perfect sense of the gamemanship that's going on here. Republicans know if we can shut the economy down for long enough, the probabilities that there's a recession by the next election are fairly high. That puts pressure on the Democrats to bow to their demands. Of course, Democrats are saying, look, maybe that happens, but we're going to blame you. The question is, who will voters remember? And that is the question. But right now, we look at Larry Fink, BlackRock's CEO, is saying economic disaster here is coming soon. He sees U.S. 10-year yields topping 5%, and that is a major issue here. The geopolitical shift is keeping inflation sticky. We're putting this to the test because that would be disaster for the U.S. economy, as his opinion is we're going to have 10-year rates at 5% or higher because it's an embedded inflation. We're underestimating the change in geopolitics is so structurally inflationary. Now, if you can imagine rates being that high, this is a problem for the government because it means borrowing costs are up. That means they have to borrow more money to fund all of their other deficits. That's an issue, puts pressure on Congress to cut spending at a time the economy is slowing. If we look at Keynesian economics, it says you kind of got to do the opposite. So that's not a good sign. It also means the housing market in the U.S., which is key to longer term rates, we've already seen it start to slow down, puts another nail in the coffin. You start to look around the world in terms of how money works. You know, you wonder why China's economy is slowing down. Why did we start with China today? It's one very important fact, because money has to circulate through the global economy. And how does that happen? It's when U.S. consumers and U.S. businesses spend money abroad on foreign produced goods and services. But if they can earn a competitive rate at home, say around 5%, and lock that money in, what happens is instead of the money flowing over to, say, China, and then China buying treasuries, and that money flowing back to the U.S., it gets trapped in the commercial banking system as investors look to buy CDs and treasuries and say, you know what, I'm not going to spend money. So we're seeing this problem here. Higher rates is not good for the global economy because money needs to circulate, and the Fed is preventing that. We're seeing all the signs come together that says this whole game is not going to last much longer. And Fink is the latest Wall Street executive to warn this week of the risk of higher rates and bond yields. Jamie Dimon, CEO of J.P. Morgan Chase, which we covered earlier this week, said U.S. borrowing costs could surge as high as 7% in what he calls a worst-case scenario. Why Pershing Square's Capital Bill Ackman is eyeing 30-year Treasury yields at 5%. And why are these CEOs eyeing, of course, the market to go higher? If you can guess, that's because they're taking the short end of the bet. We're going to show you why they already know rates are going down. They're just telling everyone they're going up so they can buy more at the bottom. Here we can see the consumer price index, this shown in red on a year-over-year rate change against the net percentage of commercial banks tightening lending standards for firms of all sizes. See, inflation's all about the money. If consumers have access to more money, there's more money in the economy, they can spend it and drive prices up. If money in the economy is shrinking or the pace of its growth is slowing, you can't have inflation. The math doesn't work out. This is how our system is designed. And sure enough, what do we see here? On net, banks tightening lending standards. That happens anytime the blue line's over the black line. It's going faster on the way up, slower on the way down. And look at that. You see inflation rising into the dot-com bubble, only to burst and come down. How about the global financial crisis? Inflation driven by oil. Everybody keeps saying oil's only going to go infinitely higher. We're saying at some point, even demand for oil is going to come crashing down. That was a deflationary move back in the global financial crisis as banks continued to tighten. We obviously see it again during the pandemic. We're seeing it now. And of course, all these CEOs know because they're running banks or large investment firms. They know what's going on, and they're just trying to get people to short the bond market more and more so they can take the opposite end of the bet. The comments come after the yield on 10-year treasuries hit 4.68% on Thursday, the highest since 2007. The surge this year has been driven by aggressive Federal Reserve rate hikes, with the latest move up caused by policymakers' messages that rates will stay higher for longer, thus bringing in a whole lot of short sellers to try to drive rates higher. But you'll notice it doesn't have that big of an impact because traders are believing that the Fed's got this right. Now, we know they don't, but traders don't understand the monetary system the way you do. So their view is they have to do anything to drive rates higher. But despite their best efforts, they're just not making enough traction. Because here we can see what normally happens when money gets tight. And if you think about this from a debt-based economy, if money gets tight and there's not enough going around and you need to keep enough spending going on to drive the economy, what do you need? Higher rates to create more money or lower rates? Now, if you said lower rates, you got it. And that's why the monetary system itself, not the traders, not the bankers, rates eventually come down, because if they don't, the whole system breaks when it's constrained of money. Here we can see on net banks tightening lending standards. Well, you do see periods where rates rise and then what? New all-time lows. You see it again, global financial crisis. Banks tightening lending standards, rates new all-time lows. You see it going into the pandemic, and guess what? Everyone says rates going up, 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 staying up. Even the Fed, we're saying, watch it, new all-time lows will happen. You'll see. And while BlackRock has previously warned of higher for longer rates, thinks that it's unlikely the world will face a repeat of the hyperinflation of the 1970s when the U.S. suffered double-digit price growth. Of course, we've made the case why that's not going to happen at all, because the money curves are saying no way this is going to happen. The money curves are inverted. The yield curves are inverted. They're saying there's no chance that we're going to see hyperinflation. You go back here into the 70s, into the early 80s, and what happened? The yield curve inverted. You see this is red. This is a 10-2s. 10-year minus the 2-year under the black line. It's inverted. Inflation comes down. Why? Because we know when the yield curve inverts, banks don't make money lending. Now, maybe they make it on origination fees and other charges, but they don't make it on the spread because they borrow at the short end, lend at the long end, and when the short end is higher than the long end, they don't make money. That means less money created in the economy, and that in turn says inflation indeed comes down. We see the same effect now. No hyperinflation, not likely. The probabilities are so low. Fink said the U.S. economy remains vibrant, and a recession, if happens, might not take place until 2025. I'll take that bet that it's going to happen long before. And that's partly because many homeowners will be protected from the spike in borrowing costs, since house purchases in the U.S. are based on 30-year mortgages. But who cares about that? What about all the credit card and other revolving debt that's affected by these higher rates? That's going to have an immediate impact on consumers' budgets. It means less discretionary spending on the way to a recession. The transmission of higher and elevated interest rates in the U.S. takes much longer to impact the economy. And whatever the recessions we're going to have, they're going to be quite modest, so I'm not even that fearful. And in turn, we're saying, look at the U.S. banking system. It's insolvent. We're not going to have a mild recession. We're going to be lucky to not have a financial crisis, because look at this, Larry Fink. Here's the evidence. The delinquency rate on credit cards, this in blue, shown on a year-over-year rate of change against the federal funds rate. The Fed hikes rates. People start missing payments on their credit cards. It's happening again. It's shooting higher. And all that tells us is we are indeed headed for a recession, if not by far something worse. My base case, financial crisis, spreads around the world, yields make new all-time lows. And with that, I'm Steve Van Meter. Thanks for watching. Thanks for being fans. Bye now.